Salvatore had asked us a question on last Friday's presentation regarding protecting his portfolio against a market downturn. This might be a concern for many of our investors in this different time of melting up and hitting new highs and then pulling back a little, but with a lot of things going on. So Salvatore wants to protect his portfolio. He says he has roughly 1,000K in a 401K, basically in an SPX fund, and he's worried about a decline maybe up to 10%. Salvatore's direct question was, as far as protecting a position in a 401k plan from an imminent market correction, which may be 5, 7, maybe even 10%, can you do a quick walkthrough of how one can protect themselves with a married put strategy or protective strategy by correlating the same amount of shares of, say, $100,000 in a 401k plan of an S&P index fund to an equivalent amount of long puts purchased in a different brokerage account? Objective would be not to sell or buy any ETF shares, just focusing on the put to protect the position. For Salvatore's case, the best protection would be SPX put options. But now comes the decision of which strike and expiration would give us the best protection. That's clearly going to depend on the amount of the expected decline and the time frame of the decline. It could be rapid or it could be slow. Remember, back in February 5th through February 8th of 2018, we saw a strong decline in the market over a 4-day period. That decline had started around January 29th at the top, but you could see that the massive amount of decline happened in a 4 or 5-day period. Whereas back in September of 2020, we saw the market down about 9.6%. But that took about 3.5, 4 weeks and was more of a gradual decline. And thankfully, the market sentiment tool on PowerOptions did trigger bearish sells prior to both events, so we were already prepared for that, and we did other webinars on it at that time when the market sentiment started to trigger the bearish sell warnings. But how can we find the right put option to protect our positions? In those other presentations, we discussed a structure for continued protection, say on a spread portion of your portfolio or the portfolio as a whole. The best protection, of course, on stock positions is opening married puts against those stocks to protect the gains that you have or to go in with limited risk, as discussed in the blueprint and radioactivetrading.com. A general approach for using index or ETF puts is looking about 45 days out or so and using a delta of 0.3, buying the put with a delta of negative 0.3, for example. Or if the VIX is low enough and you're expecting a sudden correction, such as February 5th through 8th, 2019, which no one really was, but it did happen, a similar approach of buying 0.3 delta calls 45 days out in time or shares of a volatility ETF can help hedge against black swan events and sudden declines. But let's look directly at Salvatore's concern. We have 100,000K invested in a 401k, mostly linked to an SPX ETF fund. We want to protect against a 10% decline. Well, that would be a loss of $10,000. We don't necessarily want a one-to-one hedge against that. We maybe want to hedge 50% of that decline, maybe a little bit more, so that if the market does fall 10%, Salvatore is only looking at a 5, 4, or 3% decline on his portfolio. This is where we would use the long option finder on PowerOptions. To access this tool, we can go right to the Signature Tools tab, click on the long option finder, or we can also access it under the long call or long put strategy tab. This tool is simple to use. We just put in the underlying stock symbol, our expected price after the decline takes place, whether it's 5 or 10%, an investment amount that we would put into the options to help hedge against this loss, and a target date where we expect maybe the market to hit the bottom. And what does this tool do? Once I put in my inputs for the position, it looks at every available option for that underlying security, every expiration and every strike. It looks at the current price of those options, how many contracts we could buy based on that investment amount that we entered, and it calculates for us the expected value using the Black-Scholes pricing model. Then it orders the results from which options would give us the highest return to lowest return, showing about the top 10 if the stock did hit our target price on our expected target date. Based on Salvatore's concerns, what value would I use? Well, let's take the worst case scenario. Let's say we're expecting a 10% decline in a correction. The SPX close on September 2nd was $4,536.95. A 10% decline would drop us $453.70, so the expected price of the stock is $4,083.25. Selected an investment amount of $5,000. Why $5,000? Well, it's 5% of the total portfolio for protection. Usually might use less, only 2 to 3%, but with the prices of SPX put options, we may miss some higher strikes due to a higher cost of $60 or $70 per contract that we couldn't afford with only investing $5,000. Why is that expected date 30 days out in time? Well, generally the declines we see in a 2, 3, or 4 week period. Remember what we just saw about September 2020 with that 9.6% decline happening over about a 3.5 week period. Of course, if you had a different expectation, you could absolutely set it out to 2 months, 3 months out in time, or 1 or 2 weeks out in time. What results do we get with this basic input into the long option finder? Well, naturally, since we're showing a decline in the SPX, the S&P 500 index, we're only seeing put options. If I put in a value 5% or 10% higher, we would only see call options. Here we see that the October 8th, 4,360 strike gives us the best bang for the buck with a return of 712%. Others are also profitable. We see here that the current price is $34.10 for that 8th of October 4360 put. With our investment amount of $5,000, we could only buy 1 contract. We see that the estimated price on October 4th for our 8th of October 4,360 strike put would be $276.72. So essentially we take $3,400, which would more than cover the hedge of the $10,000 loss we'd expect with a 10% decline on that larger portfolio. Is that accurate? Well, if SPX was trading at $4,083.25 on October 4th, the intrinsic value of our 4,360 put would be $276.75. So this is pretty much on point with just intrinsic value, and that's what we'd expect to get if our expectations and targets came to fruition. You might be asking, where are all the other options? Well, since we selected a target date of October 4th, we're not going to see expirations in September, September 10th, September 17th, any of those other weeklies, because our target date was October 4th for that bottom price. The farther out strikes, Novembers, Decembers, Januaries, were more expensive and had a lower return. They might have still been profitable, but again, they didn't have the highest bang for the buck of the top 10 in those calculations. Higher strike puts closer to at the money might have also been profitable, but they couldn't be purchased due to the cost basis and prices higher than $60, $70, $80 per contract, which wouldn't have met our $5,000 investment amount. Well, can we double the investment? Well, we can. I could put in $15,000. I could put in $10,000. But what are we talking about now? Now we'd be talking about taking 10% of our portfolio to cover a 10% decline. If we use $15,000, that's 15% of the total portfolio value to cover a 10% decline. If we're wrong, and SPX continues to melt up with a small correction and melt up with a small correction, we don't see that 10% decline, we're going to be losing on that 10% or $10,000 or the 15,000 or 15% that we use as a market hedge. And if we did double the investment with the same 10% expected decrease over that 30-day period, well, it stays about the same. We're still seeing the 8th of October, those options closest to our target date, which have a lower price compared to farther out options. Here we just see a little switch where the 43.50 put gives us a higher return than the 43.60 put we initially saw with $5,000. Would expecting a lower decline change the outcome? Oh, absolutely. As would a higher expected decline. If we kept going to a 20% decline or 30% decline, one not often seen, hopefully. But again, that would change the results. If we use just a 5% decline on SPX, a drop of $226.85 over the next 35 days, that would put us in an expected target of $4,310.10. Now the results we start to see are the 4,400 range puts for the 8th of October rather than the 4,300. But again, the top one here is the 8th of October 4,470 strike put, current price of $50. So we could buy one contract with our investment amount still at $5,000. If the stock did hit 43.10 on October 4th, we see an estimated value of $160. Is that accurate? Well, if that expected price of SPX is hit on or around October 4th, that would mean our 4470 put is right at intrinsic value of about $160. So that's fairly accurate expectation if that target 4,310 is hit. And again, what would this be? This would be a gain of $11,000 monetarily on one contract, hedging a 5% loss on the SPX fund in the 401k. Tips and tricks. Are these numbers etched in stone? Again, going through the whole chain, different expirations, it's using the Black-Scholes calculator to see which put option or call option would give you the best bang for the buck. Prices can fluctuate with changes in implied volatility. How do I know the expected price? Well, normally when you call us up, schedule a coaching session, or join us on the webinar, you say, I'm concerned about a 5 to 7% decrease in the market. How can I look to project it? You've already gauged a worst case scenario for what you fear. But always toggle the different declines, a 5% decline, 7% decline, maybe even a 3% decline, to see which one would give you the best bang for the buck if that's your concern. How to choose the investment amount. If you're looking to hedge a total portfolio, a general guideline Ernie and I discuss is about 2 to 3% of the total portfolio. Why? Because if you're wrong and the market moves up, you lose 50% or 60% on the hedge. We've only taken your portfolio down by maybe 1%, 1.5% or so. It's not a big loss, and hopefully the gains that you have on the other portion of your portfolio outbalance the hedge that didn't work for you. How to choose an expected date? Typically, we look 30 to 45 days out in time in this scenario, looking to use the long option finder to find puts as a market hedge across a broader portfolio, because corrections and declines usually occur in under a 30-day period. Yes, we can talk about the decline of October through November through December of 2018. We can talk about, February 26th of 2020 to March 26th of 2020. That was about a 30-day period, wasn't it? But again, usually looking out that 30-day, and you already probably have a gauge of when you expect the market to decline if you're expecting a correction. Not necessarily a black swan event, but if you're expecting a correction. So if this tool is good to use to protect a larger portfolio without using puts directly on the stocks that you own or buying shares of an index or ETF and hedging that directly with a married put, couldn't I do this on earnings? Potentially, but again, this is where that IV flux that we discussed about things not being etched in stone can come into play. NNVC has earnings coming up at the end of this week. It's currently at around $4. So let's just say we expect poor earnings and a 25% decline down to $3. We're going to take $1,000 to invest, and again, earnings are coming out soon, so we're going to set a target date of September 17th. We run that, and we see that we could see 33% returns, 20% returns on these put options with a 25% decline on September 17th. But look at those implied volatilities, 1.4, 1.44, 1.5. What's going to happen after earnings? An implied volatility is going to shift. The event has occurred. Implied volatility is going to change. So on this tool, you have the ability to recalculate using a different implied volatility. So on the right, if I expected the implied volatility of these options to be cut in half after the earnings event coming up soon, and we put in to recalculate using an implied volatility of 0.7, we see the returns are reduced. The 15th of October 5-strike put still is a good 29% return. It's not a strong return because of the implied volatility. And again, those December options wouldn't give us much of a return at all, only 2% due to the implied volatility flux. So if you want to try to use this tool to buy puts on stock around an earnings event, thinking that it might go down and earnings might disappoint, remember, change the implied volatility based on what you feel is going to be shifted after that event, so you have a better gauge of what these options would theoretically be worth in those scenarios. Is this a good tool to find put options to protect your stocks that have been going up to new highs and you're worried about a correction? Well, for a total portfolio hedge, this tool helps you save time with that analysis. But to protect shares that you own directly, that you feel have topped and may pull back, there's a better tool we have on PowerOptions called the Insurance tool under the Married Put tab and under the Signature Tools tab as well. We'll revisit the use of that tool next week when we take a look again at our hat trick for locking in gains. Now, as I mentioned, we've done other videos for stock or portfolio insurance and market hedges. To view some of those other presentations, just go to powerop.com/webinars.asp. It is a public page. Click on the Options Concepts category of the webinars and scroll down to around this 2020 range we discussed, September of 2020. You'll see webinars there from April 2020, how to hedge your portfolio with broad market put options. From September 9th, hedging leverage positions in your portfolio. And from September 13th, analyzing hedges on large portfolio exposure. Of course, you can always go to our YouTube channel on PowerOptions, use the search function there, and just look for the term hedge. And you'll see similar webinars that are available on the PowerOptions webinars page, as well as some other more distinctive webinar presentations on market hedges, stock or portfolio insurance, and more. And of course, if you want to access the long option finder to find put options to help you hedge against broad-based indexes, SPX, NDX, RUT, simply access it on the Signature Tools tab or under the long call or the long put tab and put in your values. Well, if you're not on a trial, just go to powerop.com, just put in your name and email address, and you have full access to all of our patented tools, plus the long option finder for 14 days.